We're good?
You're good.
Awesome. Hey everyone, welcome back. It's Thursday, August 20th, 2020. It wasn't a crazy day in the markets, but let's give the market update right now. Equities were slightly stronger. The S&P was up 30 basis points. Again, led by tech stocks. Despite a weaker read on initial jobless claims kind of popped back up to over 1 million. Now, I think we're in this kind of new normal-ish for COVID where there will always be kind of this highly elevated level of jobless claims, but everyone kind of expects it, and the market is definitely looking through COVID, through a recovery, and mostly on the fact that we haven't really seen consumer spending really decline all that much. And my read on that has been, ever since, we talked a lot about this last week. It's because, I should move this way, right? Again? Yeah, just a smidge. And so, my read on that is we are still kind of gridlocked in Congress over the stimulus packages or the kind of the $600 per week enhancement to state unemployment benefits. And which is why I remain, I guess, cautious in the short term, going all in, I guess, because if no deal gets done and families' real savings go away and there isn't that $600 boost to unemployment benefits, then I believe I read somewhere that the average, I can look this up just to verify, but the average state unemployment payment per week is only like $300. State unemployment benefit. I'm going to give you the right. Okay, $380 a week is the average unemployment insurance benefit that unemployed folks get, kind of averaged throughout the country. Obviously, it varies whether you're in Idaho or you're in New York. But think about that. A $600 boost to that is quite meaningful. So if that goes away and people start burning through cash, they're going to spend a lot less on do-it-yourself projects like Home Depot. They're going to spend a lot less on all this other stuff. So it's just a kind of a short-term headwind towards all that. And I think on the flip side, if you talk to kind of your hardcore Austrian economics folks, the huge Bitcoin bulls, the huge gold bugs, they would be like, well, we shouldn't give the stimulus because you're just printing money, which is a tax on everybody in itself, and you're going to cause runaway inflation. You're going to cause a lot of other stuff. Look, I'm not a macroeconomist. I like macroeconomics as kind of a bottoms-up investor. I like companies. So I don't know what is the better kind of path forward. Is it the Keynesian spend your way, stimulate your way through it, or is it the Austrian cut down spending and we need to go through some pain and all the businesses that should fail and all this other stuff? I think reality is probably somewhere in between things, just like reality is in between a lot of things, right? I don't believe the world is as easy as black and white. But as it pertains to corporate profits, even corporate profits for bulwarks like and stalwarts like Google or Apple or whatever, they're going to be the best for sure, but ad spending's down, and ad spending's going to be, which is how Google makes its money and Facebook, Instagram makes its money. That's going to be the thing that hurts. It's even going to hurt that, right? So if consumer spending goes down, specifically, I look at the world in a very U.S. centric view because my career has been covering U.S. focused equities. I've done a little bit in European and Canadian. I've done some Canadian, so I think about like kind of North American equities, I guess. And then I've done some in Europe and I haven't looked at too many Asian stocks, but I look through it in a U.S. lens. I believe the U.S. still leads the world economy, and if we see huge weaknesses, I think that's going to ripple throughout the world. So that's that. I think that's the catalyst we're really looking at. If basically a deal basically doesn't get done at all, and they just walk away from the table, I think that's not great for the stock market and for corporate profits. And so I would look out for that. And that's why I'm not fully all in. I think if you put a gun to my head, I would say that a deal will probably get done because it looks really, really bad for either the Republican or the Democratic Party to not pass any sort of support. So, let's look out for that. Cool. So that's the market update. Again, it was kind of a boring day in the market. It's been, we made all-time highs in the S&P 500. All-time highs, I believe. S&P 500 this week. And, we are, I believe we were all-time highs, or was that I believe we barely crossed all-time highs. That was, I think, yesterday. But, regardless, it doesn't matter, right? We are, as if COVID hadn't happened, on a nominal dollar basis. So what I will invite you all to kind of come up to a second order of thinking is, and I haven't done the math, right? And I don't think anybody really knows the answer to this, is yes, the stock market is valued in dollars as if COVID has not happened. We are basically right at where we were right before COVID. And so basically, does that mean that the market is valued, the same as back then? I would invite you to think that it isn't. And you can even flip it on its head. Have equities rallied, or has the dollar weakened compared to other asset classes? Right? So is it actually that corporate profits have increased or corporate multiples have increased? How much of it is that? Or is it how much less stock can you buy with your money now because the government is printing a ton of cash? So just food for thought. Why don't you crunch on that? I'm crunching on it. I don't really have an answer, and that's for old Jerome Powell to be. I hope he's thinking about it. I know he's thinking about it.